Welcome, everyone, to the Wocstar and Ghetto Film School Entrepreneur Academy Spotlight Series. We are kicking it off this October with Cleve Jenkins, who is a Community Development Officer with Institute Capital in North Carolina. We are so excited to welcome Cleve as we're going to talk about unlocking capital and a playbook for small business success for alternative funding sources. We're so excited to welcome you today. We have a variety of our alumni from the Wocstar Academy. The Wocstar Academy is for entrepreneurs who are looking to raise capital and also learn how to tell their story. So today we're really going to focus around, alternative methods of funding. So often we hear the big success stories from, venture capital and huge banks, and that doesn't work for everybody. So today we really wanted to get honest about what are different ways to overcome those funding challenges and how can we access those alternative capital methods. And so we thought you would be an amazing person to talk to with your background. I know you have decades of experience with the banks and with CDFIs. So I want to give you just a second to share a little bit about your background and how you got involved in this exciting industry. Why don't you tell us a little bit about you?
Well, yes, I'm a finance professional would be the best way to call it. I was brought up in the big banks, so I've done everything from a personal banker, small business banker. I've done treasury sales, mortgages. Uh, when subprime loans were killing our country, I was wholesaling those. So I've seen
Wow.
everything from A. Yeah, when you think back to that, yeah. So I've done everything from A paper to subprime. Right now, I'm in the CDFI, which is Community Development Financial Institution space, and what we do, we're here to basically help those underserved communities. We're a non-traditional lender, and so my purpose, just to I put that teaser out there. Our purpose is to help you get the funding to either A, get started, or B, accelerate and grow your business through that first growth phase. And along the way, provide you the technical assistance that you need to be prepared on the next time to go into the traditional bank to get the full suite of services, lending, and everything that you could need to advance your business forward.
Awesome. Awesome. Thank you. And I want to say thank you for your service. CDFIs, I think, are such an amazing asset for everyone. And we're excited to bring you here today because we've been touting what a huge plus it is to work with a CDFI. There's so many benefits. Like you mentioned, it's not just thinking of it as a funding source, but all of the other technical enhancements you can provide and the partners you can introduce people to. So we're gonna get into that in just a little bit. My first question is that, in today's day and time, many entrepreneurs are feeling overwhelmed or discouraged, just with the current state of affairs, but also from hearing no from traditional lenders. From your perspective, what would you say the most common reasons that those big banks will turn down small business loan applications? What do you think are key things that I, as an entrepreneur, might want to know before I apply?
Well, the first thing and the part that I didn't mention is I also come from the perspective of an entrepreneur, because I own my own commercial cleaning company, and that was my second business. The first business venture did not work.
Ah,
So I
yes.
know
You got both
what the
sides.
yes, I know what the rejection feels like, and I fell into a lot of the commonplace mistakes at that time. But the biggest thing is, one, you have to go in and educate yourself and surround yourself with those that can tell you what you don't know. You have to build a team. You don't just think and scribble a couple of things on the back of a napkin and I've got a great idea and boom. Next thing you know, you're in front of a lender trying to get money. That is just the no toll road to just being stressed and getting a lot of no's. So the first thing you do is seek out maybe some technical assistance with your business, small business centers that are at the I know here in Charlotte, we have them at a lot of our technical colleges, our community colleges. They have small business centers. As part of our nonprofit, we're a multi-pronged nonprofit. We have women's business centers, which also work with men and everyone else as well, but they
Yes.
assist with technical assistance. They help you, find out, get your banking documents in the form that you need them in to go apply for a loan, review your credit with you, help you understand what's to be necessary to get a loan when you walk into the bank. Make sure all of your paperwork is in line, that you're keeping accurate records, that when asked a question, and help you think through your plan so that when you go forward, you already have anticipated the question that's going to be asked, like, well, how is your credit? What is your, have a very well thought out and vetted business plan, which is always key, because that gives me a snapshot, a quick synopsis of what you're trying to do. You're generally going to have a SWOT in there, SWOT analysis, strengths, weaknesses, obstacles, all those things that were in there. It gives me a good look at
Yeah.
where your business is, where you are right then, so that when we decide to go forward, you kind of are informed. Because when you go in just saying, oh, I'm new to this and I don't know a lot, we're going to smile and say, oh, don't worry, but it to the banker doesn't mean 2 cents to me. And I'm
Yeah.
just being honest. And I can tell you, oh, yes, I can see, I understand, I've been there, but you're not yet ready for us to go forward and talk about lending. Uh, Secondly, you absolutely need to know, did you go to the right source for lending? For if you are a pure startup, okay, first and foremost, CDFIs are actually one of the few ways that you can go and actually get financing. The traditional bank, just know off the top,
Hmm.
they are not lending money to a startup. You see, what they
Yeah.
tell you is, when you ask, well, do you lend to startups? They say, oh, we'll lend to anyone with 2 years financials. Basically, they just told you they don't lend money to startups. If you're a startup,
Yeah.
you're not going to have 2 years of financials. Now, here is the other secret that the big banks won't advertise. But right now, what I'm seeing across my desk tells me that that is in place, meaning banks make money off of lending
Hmm.
and they don't mind lending, but they're not jumping up and down doing cartwheels to lend money, meaning they generally lend money in most cases to either gain deposits or
Yeah.
save deposits. So just know
Hmm.
that the reason that I'm here strictly from a lender, the reason that banks like to send their people to me, to CDFI, is I'm not a depository. So all
Yeah.
I do is the lending piece, and part of my job is to get you ready to go back to that same bank. So the next time that you can get the money that you need, the resources that you need, and they know I'm not trying to take their deposits.
Right,
And
right.
so,
No, that is such a
so
good point, Cleve. I love that you mentioned that, because I think, we think of them as in competition, but they're really not at all. You're helping them too, and they're helping you.
well, yeah, they send me referrals. I get the people back to the point, or up to the point, where they can be bankable by that bank, and then they can take that customer and grow forward. Because by the time you've come and done business with me, you understand what I need, but you also will understand what you need to take the next step in your business,
Mhm.
how to go. Because I tell people that I'm a non-traditional lender, and in transparency, when they come and be like, well, the bank is offering this, and this. Yes, the bank is. And if you are ready to go to the bank, I would say absolutely, that's what you need to do. But understand, the bank is a depository. They're lending their own money. So they can get below prime. I'm going out and getting my monies. Either I'm getting it from another bank at a reduced rate, the CDFI fund, philanthropic efforts of people donating money and giving grants to go put into the community and help, meaning I can't get as low as that bank can get.
Right,
So
right.
that's the first thing, is so that's why I'm trying to get you prepared to take the first step. And the biggest thing that all should know is engage your banker early.
Mm.
Meaning, I'm going to be able to tell you if you're ready, but I'll give you this scenario. After a couple of no's, a lot of clients, they get frustrated and they go and they just utilize their own monies. Now, here's the difference. I'm going to give you three options. I'm going to give you the option of using their own money, the option of using me, and what happens when you go to the larger bank, and you'll see in that why I'm a better option to help you get started. Now, when you go to the larger bank, first and foremost, credit score. Now, one, the CFI that I'm working with, our purpose is to help those underserved communities. Now, we do loans to everyone, but we're here to primarily try to focus on the underserved communities of minorities and women. And so when understanding, you have to understand the challenges of the group that you're trying to help if you're able to help them. Now, credit is a big challenge in that group because for a lot of the persons in that group, you're not being schooled on the need for good credit, how to establish good credit, and how to keep good credit at a young age. By the time the first person pulls you to the side and tells you what to do to maintain your credit, is probably because you've already messed up,
That's so
unfortunately.
true. Yes, yes.
And so with that being said, though, understanding that challenge, the large bank is looking for an entry score of a 675 to a 700. I'm looking for a 600. That 600 credit score is going to allow more people to realize their entrepreneurial dreams, to be a part of the American dream and all those things. And you still have to the third option, which I'm going to get to, is you just using your own money. And I'll get to that about midway through this. But secondly, they're going to look at equity investment. Anyone is going to ask, what do you have to invest into your own business? What do you have to get into it or to put into it? Now, that large bank is looking for generally 20%. So if you have $100,000 project, they'll give you 80. They're expecting you to bring 20 to the table.
Mm-hmm.
I'm looking for a 10% equity investment. Once again, understanding the needs and the challenges of the market that I'm trying to serve. Saving money is difficult because you're living paycheck to paycheck. So I have a 10% investment. Okay.
Mm-hmm.
And the third leg of that chair would be cash flow. Now, on the residential side, from doing mortgages and things of that nature, we're accustomed to working with a debt to income ratio, which is generally about 60%. We run on the commercial side, because I'm doing commercial lending for your business. We run the somewhat of an inverse of that. It's called a debt service coverage ratio. And it's basically what it says. It's the ratio of you covering your debt with income. Now, what the large bank is looking for is a 1.2, 1.25, let's say a 1.25 coverage. And what they're saying is globally, when they take all of your personal debt and your business debt, okay?
Mm-hmm.
And now I've taken all of your personal income, your W-2 income, any, disability income, alimony, child support, any forms of income you have, plus your net operating income. I'm looking on that traditional bank, they're looking for $1.25 of income for every dollar of debt that you have to service. That's where you get that 1.25.
Gotcha.
I have a 1.1. And what that means is I'm looking for $1.10. I'm discounting you 15 cents on the dollar, which is a lower tier. It helps more people get in. And then lastly, all institutions, generally most, are what we call secured lenders, meaning we like to have collateral. I can't do any unsecured lending. Banks are not going to do any unsecured lending. Truly, truth be told, during COVID, a lot of us thought or think that the SBA is a lending institution. The SBA at its core is not a lender. They give out loans via the government's money for disaster relief, EIDL loans, and they put the PPP monies out there. But what the SBA truly is a guarantee organization. So what they're saying is, if I meet their guidelines with my loan, they're there to help you with lack of collateral or not enough collateral. So what they're saying is, depending on the amount, the program that we're in, the Community Advantage program, it goes up to $350,000. It was 500, but the present administration decided to leave that at 350. But what they're saying is they're guaranteeing that loan to up to 75, possibly 85%. And that 75 to 80%, 5% guarantee is what encourages the lender with that reduced risk to make the deal. So they're there to help for our purposes with lack of collateral or no collateral. What they will not help with is, I've got collateral that I don't want to pledge. They're going to be like, okay, then what are we talking about? So now we've got parameters of the two, the traditional bank, the non-traditional bank. You know what the big bank is looking for, you know what I'm looking for. Now let's go to that third option, that you've gotten frustrated at the traditional bank, and now you're deciding, I'll utilize my own money. Okay, let's now leave the traditional bank over there because they've already turned you down. Now you're here with me, who you may or may not know that I exist, versus using your own money. Now, let's say you have a $200,000 project, okay? First and foremost, before I even go into the second half, know this: the reason most businesses fail is they're underfunded to start with. You never gave yourself a good shot at success because you were underfunded. You didn't have the money to really do what you needed to do. That lack of funding caused you to cut corners, and it just didn't help you get across the finish line. So let's take that and the fact that you're now going to use your own money. Now you have a $200,000 project, but you take your 401k and your savings and you turn it upside down and you shake it. There's nothing left but bubble gum and lint. You got 150,000. You had 150,000 there. Now, first and foremost, you're going to say to yourself, I'll just make it work with 150. Once again, you have already underfunded yourself by 50. Okay. Yeah. Now, if your plan was good enough in your mind to be successful at that point, your business plan would probably be good enough for me to loan you money. So let's look at the comparisons of what you've done. You took 150 for your $200,000 project. You've already shorted yourself 50,000. You're behind the 8 ball as you get started. If you had come to me with a solid business plan, okay, $200,000 project, I'm asking you to put up 10%. That's 20,000. Okay. So now you use 20,000 versus 150, and you got all that you needed to get started and give yourself a good chance at being successful. Now, what you've done with the 150 is you're already underfunded. So a year and a half, 2 years down the road, if you are lucky enough to get around that corner, you don't have any monies now left to reinvest to your business to help it grow. Okay. Yeah. So, but you weren't able to get around that corner. So now you've got 150,000 gone. You have no retirement. You're sitting block zero. You have no generational wealth to pass down the line. You have none of the things or the levers that would be helpful to help you achieve upward mobility in your quality of life. And your money is gone, versus if you'd come with me instead of 150,000, use 20 of that, you still had another 130,000. You've grown the business. Now you're around that corner. You still now can take another 20,000 and do another loan. And now you still have 110,000. So guess what? You gave your business the best opportunity for success. You got it off the ground. You grew it. You still had 110,000 to it, of your savings. So now retirement is not just a word that you see in the thesaurus. It's actually, the dictionary is actually something that you may be able to. The kids may still kids may actually still be able to go to college. All those things are in place. Those right there is a blueprint of a lot of things. I've given you what I look for in a loan.
Mm-hmm.
Think about it. I've given you all the parameters that I look for, what you need to have somewhat in place to be able to get a loan. I've also told you what the large traditional bank is going to be looking for. So I've also told you what we're working towards to get you to, so that you can go to the next level and grow more efficiently. And thirdly, I've also painted how the average business owner does it, the pitfalls to doing it, and where it leaves you.
Yeah.
So really, I threw a lot out there in that little spill. But yeah, that's a little bit of how we work, how the big bank works, why you should be here, what I'm going to be looking for, and that is where the conversation starts.
Awesome. Thank you. You like answered half my questions with that, so that's beautiful. I do have a couple questions in the chat that I'm going to get to. From Vonti, she asks, "What is the threshold of profit you wish to see before going to a commercial lender?" We had a few in our class. I'll say we had a variety of mostly early stage businesses with a variety of profit levels. So I think her question is just, what's a threshold before? Vonti, are you asking before coming to him or before going to the big banks? A
Oh, I'm
commercial
sorry. I got it.
lender.
Okay, well, what is the threshold profit before going to a commercial?
So
Okay, it is not around the level of profit, because what you're saying is, for instance, you can have one business may run a 30% net margin, the other business may run an 8% net margin, but the net operating income, the NOI, is the same. So you're not looking for a level of profit. What you're trying to do is to see if your numbers are ready to hit the levels that I just spoke about. So what am I saying? If you are now, I'm a commercial lender, but I will assume that you were saying going to the large bank. Okay, then what you would need to do is, when you get your profit and loss statement, or at the end of the year, when you get your tax returns. Now, when it comes to underwriting, there's a few things, caveats that you wouldn't know to throw in, that I'll just throw out there and let you know as you look at that. I'll throw one and just give you the example: depreciation, for instance. If you own a business, if you're an LLC on that Schedule C on your 1040, if you're an S corp, for instance, at 1120S, when they're breaking down your income, they're going to have all your expenses over there. Now, depreciation, for instance, you get to add back depletion, depreciation, and interest. I'll use depreciation as depletion is if you like a natural resource like fuel. Like, let's say you buy a fuel tank and you buy X amount of fuel because you have all these vehicles to gas up. Depletion of that asset is somewhat a depreciation. So when you write depreciation off on your tax returns, it's for tax purposes, but it wasn't a hard actual dollared expense. If you paid interest to the loan, and they let you turn around and write that off but you just serviced the loan. It wasn't a true extra expense. So when I go see that, I'm going to add that back. See, so I may have started out with a person that may have only had 30,000 of net operating income. But let's just say they had another 40,000 in depreciation and another 50. With that 50 and 40, that's 90,000 of income that I'm putting with the 30. Now they're actually at 120,000 is the income that I'm utilizing to underwrite them. The point of all that says is, you're not working towards a certain profit margin. You're working to be able to cash flow the things that I just said. So if you, for instance, let's just say I go to your credit report and I see that between your personal debt and your business debt, let's say you're servicing 10,000 a month, right? Okay.
mm-hmm.
I'm going to need to see 11,000 of income coming in monthly to service that at a minimum of a 1.1. The big bank would need to see 12.5. to service that at the acceptable level. So it's not necessarily a certain profit margin. It's, are you being profitable enough with what you got coming in versus what you've got going out that you have enough room left? Now, here's the other thing that I didn't throw in. When I'm utilizing that calculation, I'm also taking, like, let's say you've got the loan we're working on, it also gets thrown in there as
Oh,
debt, because I want to see if you can service it after I give you this loan, right?
right,
You,
right.
if you're at a 1-1 and I haven't added my loan yet, you're not going to make it.
Yeah.
Because once I add my loan, you may be at a 0.9. That really means you're 10 cents off the dollar in the hole every time.
Mm-hmm.
And so that means, what are you doing? You're probably hitting your savings every month to maintain.
Right.
So it's not a particular percentage. You're just trying to be able to cash flow at the level that I spoke about.
Okay. Thank you. Thank you for clarifying that. I
Mhm.
think on there, so similarly, could you break down net operating income a little bit more for them?
Okay. When in either your Schedule C or your 1120S or your profit and loss statement that you should be doing quarterly until you get to the end of the year, you have all revenues coming in. And all of those, when you compound all the different ways of the revenue you have coming in, that's basically sales numbers, that's revenue coming in. Now, the first thing you take off of that is cost of goods sold or cost of services offered. Now, some people choose not to put anything there and they just take it all down to expenses. But cost of goods sold would be, hey, whatever you put in, the base that you put in to establish or to get the product that uh, let's say you're selling something where your wholesale cost, that's a cost of goods sold.
Yeah.
Okay. Take all of that off of your gross revenues and get you to gross profit. Now, once you get to your gross profit number, you're then looking at expenses, whether you're going to calculate them monthly and calculate it out, or you're going to do it on a total annual basis. Because when you look on your return, they're looking annually. So you get to your gross profit number. And so if you started out with, okay, I did $1 million and in sales, and I had 250,000 in cost of goods sold. That means now my gross profit is down to 750. Okay. So then let's say I had 650 worth of expenses, i.e. payroll, insurance, keeping the lights on, fuel in the vehicle, all of those things. I had another 650. That means now my net operating income is 100,000.
Perfect. Perfect. Thank you.
And let's
Thank you
just
very much.
hope that number, if you ever look down and you see that number and it pops up on your spreadsheet red, that's a no. That's no bueno. That's not
Yeah.
good. That means you're in the
Yeah.
red, and
Yeah.
that's a loss. Just posted a
Yeah.
loss. So keep that
Thank
number in
you.
the black. Keep it in the black.
Keep it in the black. That's right. I will, and that's a great question. So, you broke down the three situations, which I think was really great, in explaining, the benefits as well of working particularly with you versus a big banker versus going into your own. What would you say would be an ideal customer to come to you? What would be the terms? What would you like to see if I, Colleen, come to you as an entrepreneur? I've got a 600 credit score. I can do that 10% down. I've got all my documents in a row. But what else would you want to see from me?
First, let's go a little higher. 600
Okay.
is my floor, so let's throw that to
Okay.
700.
Right.
If if
I'm
we're at a 600, we're already at the low end of the pricing scale. So let's leave
good point.
ourselves
Good
a
point.
little leeway. What would be a good clean package is, hey, you've got a solid credit score. Let's just say 700 on the head. You've got a
Mhm.
700 credit score. Let's say you've got your 10% down. But when I look at your personal financial statement, I also see that, well, you've got a nice little bucket of reserve cash over there. What that lets me know is if need be, you've got money to live on. And if need be, you've got money to bail yourself out. That.
Yes.
So now
Yeah.
I've got a good credit score. I'm looking at, I've got my 10% to put in, and I've got good liquidity. Now, a business plan where you are starting your business, but it's a business that you, or let's say you have a spouse and the two of you are doing it together. One person is doing the business, the other spouse is still working, which provides a secondary source of income, secondary source of repayment for that loan if something should go astray or not as planned. That always makes us feel nice and happy. It gives the lender a nice warm. So now we've got the nice credit score, we've got the 10% down. And so let's just say collateral wise, I've got a nice strong, because I can go by saying I'm asking for 10%. That's saying I'll do a 90% LTV, loan amount to the value of the collateral that you just put up. Now, good solid collateral that I know I'm not going to have to struggle to find a value on, and I'm not going to be too thin. That's always a great place to start right there. And now when I look at the monies that you've already got coming in, the monies that you're projecting to make off of getting your company started, and I'm looking at a 2+ on my debt service coverage. And what that ratio means, that instead of hitting the 1.1, you're at a 2.0. That means your numbers are easily able to cash flow, meaning I could discount your projections by 25, 30%, and you'll still be able to cash flow. Those are the things, those are the easy ones. Those are the bunnies, those are layups. I don't have to think about a lot of mitigation of how to, well, they didn't have this, but they had this. That's the easy one. So if you ask me, would I be looking for a perfect file? That would be it.
Okay. No, that's super helpful. Thank you. So you mentioned earlier, and we've both discussed this in our intro, about the other services that CDFIs can offer besides lending. I want to let this audience know that there is quite a bit available in terms of technical assistance that you guys offer too. Can you talk a little bit about that?
Now, for our organization, maybe not all CDFIs, but my organization is a 3-prong. We have several forms. And so what happens, I actually have a division that's working on getting regulations and laws at the state level, because we're a state organization, that would inhibit those minorities, women, from doing business with the government, larger contracts and other. They're trying to identify those hurdles, take those hurdles down. We have a transportation resource center that helps those that need bonds to do logistics, helps them understand what they need to do to get federal contracts and state level contracts with DOT. They're helping at that level. And then we have our women's business centers, which provide pure technical assistance to business owners for getting started. And if not there, I can always send you to the closest community college or technical college, and they're going to have a small business center there that would help you put together a business plan, think through it, basically check over your accounts, make sure that, you've got your banking account set up, that you got your returns in order, look at the return, make sure you've done returns. I mean, the guy, I get them in here all the time. Oh, well, I got to do my returns first. Okay. Well, you didn't say return, you said returns. Yeah. I get the last 2. Okay. When you tell me you've not done your tax return in the last 2 years.
Oh, Lord.
Don't tell me that.
Yeah. Yeah.
That's not a good thing, because I'm thinking all types of little Oliver, Stone conspiracy theories. Then, wow, you're that bad. Why didn't you do your returns for 2 years? No, just make sure you've got all your ducks in a row. And it's like most things. And it's not and I'm not telling you or anyone to hide things from your lender. Wait, let me ask you questions.
Mm-hmm. Mm-hmm.
Now, if I was sitting on your side, wait for me to ask you questions. Don't get diarrhea of the mouth.
Which is
Um,
a very good point. I think people get in these situations and nervous, and they just give you, just like you said, all these.
you just start telling me because when you're starting out, you're usually telling me the challenges.
Yes,
Uh,
yes, yes.
you know what? I'm pretty experienced at what I do. There are certain questions I'm going to ask you, but it's
Mm-hmm.
the same thing when I take your loan and I present it to the committee. Each member on my committee has at least 25 years of banking experience. I'm going to give them the base information they need, and I'm going to shut up. If they have a question about it, they will ask me the question about it, but I'm not just going to volunteer. Now,
Right.
mind all of it wouldn't be sitting in front of them if it didn't hit all of my lending policy. But what I'm saying is these little points that might make one think a little more negatively over here. Well, I'm not going to volunteer that information. You're a
Yeah.
very experienced banker. I'm going to wait for you to ask me your question and then I will answer your question. But I'm not just going to bust out and be like, oh yeah, man, that collateral might be in a flood zone, and you know, and my cash flow. Wow, that job I just started, I don't even like it. I'm not. Don't, wait for me to ask you. Wait for me to
Yes,
ask.
yes. That's a great point. Um, on that note, what's one, as you've seen both sides as an entrepreneur and as a loan officer, what is one mindset you think our entrepreneurs should change when they're thinking about funding their business?
Using their own money.
And we just heard why, right, guys? So
OPM, other people's money. You should
yes,
tend
yes,
to use other people's money to the extent that other people will give you their money to use. Now,
yes.
you're going to always have to bring some of your money to the table as well. But if you need 200 and I tell you, all right, just give me 10 and we're good. Well, that beats you coming up with all 200 yourself most days.
Absolutely.
And
Absolutely.
don't get frustrated along the way. Yes, they're going to be no's. I'm not going to tell you they're not. They're going to be challenges. But she used to irk my nerves, but I had a boss that would tell me, well, Cleve, I know it's a hill and a challenge, but that's no hill for a climber.
Oh, that's a great one.
So understand going into business for yourself offers a lot of rewards, financial, availability of your time if you're running it properly, but it's not for it's like college. It's not for everyone and it's not easy.
Right, right.
I've had to tell one or two after listening to them. I said, okay. I said, well, do you have collateral? Yeah, but I'm not going to put it in my house and stuff up. I said, okay. I said, well, do you have money to invest? Well, that's my savings. I said, you know what? You need to continue to be a worker.
Yes,
You have
yes.
a worker's mentality. You don't want to take any risk. You want everything to be nice and comfortable. And that's not a bad thing. But what it says, if you're risk averse, if
Yes.
you want to, I go in and hit the clock at 9 and I leave right at 5 because I got stuff to do, you don't have the mindset or lifestyle of a small business owner. You are a worker. Everything
Mhm.
that you have said says that you are a worker. And if that is your mindset, you should probably stay a worker.
Yep, yep. I think that's such a big point to make, especially right now when a lot of people are looking for other things to do, and thinking, I'm just going to go out there and I got this idea. You really have to evaluate yourself and your idea. And there's a lot of resources to help you do that. I know we're almost at 10 minutes, so I'm going to open up the floor for a couple questions from the audience.
Mhm.
Um, Nikki says, can you talk about how creative filmmakers can work with you? We typically need large funds to make the film. It takes a while to get payments back from the sale. In our case, how can we be financially in the best position to do projects like that with you?
Okay. You, not as much as a loan, you need investment capital. You need someone more willing to invest into your project for a return on the backside of your project. Because remember all the things that I said that I needed to do alone. It does not matter what your industry is or any of those things. Well, it does. So let me take that back. It does to a certain. There are certain industries that lenders are not going to make loans to. We're not going to do any of the sin industries. So if I'm talking to West Coasters, no, I can't do your cannabis shop. Uh, I can't. I can't do your strip club. You know, yeah. I mean, I'm in the South. Your liquor house. I can't do any of that. So it does matter to that extent. But yes, you more so. Now I can tell you, if you've grown yourself to the point you need now, as far as what you either need investment capital or you need to have enough, let's say, real estate that you've got enough equity in that you could possibly go and get a line of credit off of. Or if you've got a business where you've done a few films and now you can get a line, because that's truly what you need. Something where you can pull the money down now when you need it. And in 10, 12 months, when you get your money or start getting your money, you can pay the line back off. But yes, that is more along the lines of investment capital or almost venture capital, just because, again, it would be so hard to get a projected number on a movie.
Yeah.
Because how many big movies that had the biggest actors, the biggest names, and it just flopped? And then how many other ones were just started out as the small movie that nobody had heard of and was on this platform, and the next thing you know, boom, 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 it hit, everybody loved it. It was a big hit.
Yeah.
So, no, it's not to say that we can't help you, but it would probably be based on secondary income sources, i.e. you have another job and you're going to utilize that to cash flow this. You have adequate collateral, you're going to use that to collateralize. Yes.
Okay, awesome. Thank you. Can you share a little bit more? I know we briefly touched on this, but alternative financing options like SBAs and microloans. What can you share a little bit with the audience about those and when you would recommend looking at those versus going to yourself or VC capital, for example, or anything like that?
What you just mentioned are not necessarily alternative loans. They're types of loans or resources within a particular, meaning micro loan. It means nothing more than small loan. I do micro loans. Anything under 50,000, I consider a micro loan. Now, here's the one caveat for me. Now, we're trying to get in that program, but right now, in case you haven't heard, the government is shut down. One of the things they shut down was the SBA. The only thing they're doing is so I can't even send a deal through the SBA right now, but so I have a micro loan program, but I'm not in the SBA micro loan program. So under 50,000, you've got to straight up have enough collateral to cover it because I don't have that SBA to go to. So a micro loan just simply means a smaller loan. And SBA, remember my earlier statement, the SBA is not a lender per se. They are a guarantor of lenders. So they're guaranteeing another lender to go ahead and do the deal. So those now, there are several ways. There are ways you can go and get loans, these online lenders that just go on monthly deposits. And all of these, I'm gonna just be honest. I should be the last resource. CDFIs are like the last resource that, you know, you can expect not to get just absolutely hammered on. But the one that I will say stay away from at all costs, I've had one or two people, but most times they don't work them way out of it. Those merchant processing loans,
Yeah. Yeah.
borderline predatory. I mean,
Absolutely.
borderline predatory. They're not, because they haven't been tagged at, but I would just say that if you go into that, that's like your last ditch effort. Like,
Yeah.
there was
And
nothing
they're
else.
so prevalent, and it's very scary, I think, you know.
And that's why you see so many businesses folding, because yeah, they give you the upfront money, and then when you squander it, they're taking off. So they're taking their money. You know, I had a dry cleaner that I know a friend owned. Well, if you know dry cleaners, I mean, it's not steady money every day. I mean, how many of us still, I have the dry cleaning bill, but how many of us still have a dry
Right.
cleaning
It's
bill?
exactly.
Young
Yeah.
son went out and got one of those loans, and they were taking the first 300-400 a day, was going to the merchant processor to service the loan. He would have days when he wouldn't even get the 300-400. So guess what? You're in the hole now. So now you got 150 from this day rolling over to the 400 that you owe. For now you owe 550. Well, if you did 550, you didn't make any money because they took it all.
Right. Right. Yeah.
I mean, so I would just say be wary of those. But if your business is properly planned, you should not have to resort to those levels of lending, especially to start up. And here is the other part, guys. This is not the glass half empty side of me, but this is also a reality, because banks, lenders such as myself, we will give money to help you start your business. We will give money to help you grow your business. What I will not give you money for is you're already taking on water and you need me to throw you a lifeline. No, that's what EMT is for. We don't throw lifelines. And it sounds rude, but it's because on paper lifelines don't make sense, you know. So, you know, and the story that I'm saying is, and I had to realize this in my first one, so I'm not telling you anything that I didn't have to do myself.
Mm-hmm.
I had to understand when I had lost enough. I had to be able at that point to swallow my ego, say this one didn't work, but I go back to my earlier statement, there's no hill for a climber.
Yeah.
And to realize that the money that I've already lost, cut your losses now. And I cut my losses then, regroup, saved up some more money, and understand this. If you lose a chunk of money the first time, you will definitely be more diligent in your efforts the second time.
Yes.
But
Yes.
it's just
Amen to
know
that.
when to say enough is enough, because it's your baby. It's something you started. And sometimes we hold on too long knowing it's just digging us a further hole to get out of.
Yeah. Absolutely. I think that's actually a perfect place to close, and we're right at time. I just want to make sure no other questions in the chat. Oh, we do have one. Do you work with investment capital, or do you refer out to partners?
Yeah, I might have one investment capital in my portfolio of people, but it's a totally, every now and then I get the one, but the person that needs pure investment capital, they pretty much don't make it to me, because some banker has already told them, you need investment capital. You know, this is not a lender thing. I've got this great idea and I've got to do this and this and this and this. And I've sat there and listened to a couple and I said, can you hit the things I just talked about? Well, no, I just told you all these things. Again, I'm a lender. You needed investment capital, not a loan.
Yeah.
You have no way to cash flow the loan. I'm a cash flow lender. Trust, we take collateral, but I'm a cash flow lender. We don't particularly want your collateral because I got to service it. I got to pay any taxes on it, blah, 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 blah. I have to keep it up. If I take your home, I got to pay HOA fees, property taxes. I got to pay somebody to upkeep the grass and stuff so the HOA doesn't fine us anymore. I would much rather you just pay the loan.
Yeah, absolutely. Absolutely. And I think for those that are listening, with regards to venture capital, that is, Wocstar is a venture capital firm. The Academy is a resource for you to learn about how to get venture capital ready. So I will put the link in the chat there. But I do want to thank you, Cleve, so much for today. This was amazing. You're a fabulous guest. There's so much knowledge we all learned today. We will be sending out this replay of the video and sharing Cleve's information as well. And please, if you are in North Carolina, the Institute is an amazing resource for you. Cleve, I can't thank you enough for sharing your time with us today. And we really appreciate all your valuable insights and the different resources you shared. For those of you that heard in our conversation, there are a list of things you need before you go in for these loans. So we've included the list up here on how to prepare for a loan application. You need to have your ducks in a row, folks. What does that mean? Know your numbers, know your credit score, tell your story, know what you need, ask for the capital. And what do we say in the Academy? Double it. Organize all those documents, be open to technical assistance, build those relationships, get to know your banker at the beginning. And last thing, avoid that quick fix money. Don't look for those payday loans or those merchant loans. Bad, bad, bad. So that's it for today, y'all. Thank you so much for joining us. We have plenty more resources coming up in our upcoming Spotlight series. The next one will be on October 23rd, and then following that on October 30th. Check out our website at wocstar.com/spotlight-webinars for more information and to register. We look forward to seeing you all, and thank you again to everybody who joined us today. Have a wonderful day.